I'm Cynthia Rowland, and this is episode 82 of EO Radio Show. In today's episode, we revisit the duties of directors in managing investment assets, and I'm joined by Jennifer Nelson, who is a senior wealth manager with BNY Mellon. We talk about practical advice for directors serving on the investment committee and on the board, best practices for the board to develop an investment policy, investment performance measurement concerns, the use of outside chief investment officers, and other discretionary asset management arrangements. So that's a lot of content, and stay tuned for a lot of great conversation. Welcome to the EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. Before I dive into the conversation with my guest today, Jennifer Nelson, I want to give a legal overview of the rules relevant to the duties of the fiduciaries charged with a charity's investment management. State law prescribes the fiduciary duties and the standard of care for nonprofit boards. Nearly all of the states have adopted the Uniform Prudent Management of Institutional Funds Act, known by its acronym UPMIFA. Pennsylvania is the sole exception, and its laws aren't dramatically different anyway. So UPMIFA generally directs that the board consider 9 factors in the context of its investment management. Number 1, the charitable purposes of the institution and the purposes of the endowment fund. Number 2, general economic conditions. Number 3, the possible effect of inflation or deflation. Number 4, the expected tax consequences, if any, of investment decisions or strategies. Number 5, the role that each investment or course of action plays within the overall investment portfolio of the fund. Number 6, the expected total return from the income and appreciation of investments. Number 7, the other resources of the institution. Number 8, the needs of the institution and the fund to make distributions and to preserve capital. And finally, the 9th point to consider is an asset's special relation or special value, if any, to the charitable purposes of the institution. In addition, the laws provide that the board should not make fund management and investment decisions in isolation and should consider the context of the investment fund's portfolio of investments as a whole and as a part of the overall investment strategy. The strategy must be based on risk and return objectives suited to the fund and to the institution. The board must diversify the investments unless the board members determine that because of special circumstances, the purposes of the fund are better served without diversification. Subject to these standards, the directors can generally invest the endowment in any kind of property or type of investment. Most large charities appoint an investment committee of board members. Typically, the investment committee is delegated the duty to develop an investment policy, periodically review and amend that policy, oversee the investment performance, oversee decisions about the selection of investment advisors, and review the fees and performance of those advisors. It's important that the investment committee include board members with expertise relevant to the investment strategy adopted by the board. With that being said, not all investment committee members have to be investment professionals, but all should be relatively conversant in investment management and able to ask the right questions at the right time about the decisions and choices made for the investment policy, asset allocation decisions, and comparisons of performance against benchmarks. So with that background, I'm really, really happy to be joined by Jennifer Nelson, who has ideas on all these topics, I think. So thanks for joining me, Jennifer.
Yeah, I'm very happy to be here, Cynthia. Thank you for having me on.
Sure. So here's a little biographical information about Jennifer. She's a senior wealth manager with BNY Mellon, and she's been there for the past 8 years and spent 8 years before that at Cambridge Associates, which is a leading investment consultant for endowments and foundations. At BNY Mellon, Jennifer focuses on investment management and complex planning for private foundations, endowments, and high net worth families. She lives in the San Francisco Bay Area with her husband and 2 sons. She's an avid swimmer and loves to read fiction in her spare time. So, Jennifer, with that little bio, tell the listeners about what drew you to a career in investment advising. It's certainly got to have its challenges and its rewards.
Sure. So I started right before the peak of the financial crisis. My first job was with Cambridge Associates, and it was an extremely challenging but beneficial learning experience to work throughout that market collapse, for lack of a better word, and see how the investment world changed coming out of that. And it was particularly helpful to see how different endowments and foundations actually dealt with that challenge and how it's changed the industry going forward. And that helped me really get interested in discretionary asset management, which drew me eventually into the wealth management space. I've continued to very much enjoy working with endowments and foundations. I was very involved with them growing up as well and throughout my time at university. And it continues to be a big part of my current practice with clients. And I'm happy to start kind of talking through some of the things to think about for board members and committee members.
Oh, that's fantastic. So I've sat in on many board meetings over the last 30 years, and I vividly remember one of the first ones where a foundation had come into, it was a new foundation, and it had just come into substantial assets that the board had to invest. This was probably around 1999, 2000. And the investment advisors at the time said the market could always turn, so let's phase in the investments. We're not going to do it all at once. And at the time I was like, gosh, that seems so conservative. And now with 3 decades of experience, I'm like, oh my God, go in even slower than that. You live through enough of these business cycles and you start getting very careful, which is what you do. So that's great. In my practice, like I said, I often see either foundations that come into a new amount of, their first endowment, their first substantial amount of assets to invest, and so are kind of new to this whole field. And also on the flip side, you see new members come onto a board of a foundation that already has substantial investment assets. The topics you would include in an orientation for board members, either serving for the first time where there are substantial assets, or for the entire board when they suddenly come into these investment decisions?
Sure. So a lot of this is going to revolve around the investment policy statement. So I will be using that or the shorthand IPS quite a bit because it is such a core function of the board member's role to, especially if you're going to eventually use discretionary asset management, you have to have a very well thought through and strong guideline for that discretionary asset manager. The first thing I believe that board members want to think through is just sort of the general investment policy. So that's understanding the rules and the roles for the various board members and the various committees, the process and frequency of any updates to that policy statement, and then also who's responsible for the risk management, the monitoring and reporting. So typically that's an investment committee, but there's various ways to do it depending on the size of the organization. The second thing is to really look at the spend policy. That is, and you touched upon it when you were talking about MIFA, but it's really to ensure that the appropriate spend policy is in place for the organization. If it's an endowed asset base, then of course you have to look at the percentage that you're spending, make sure it's not too much. I think I've seen this personally where an organization will have that either 3% or 7% spend policy that's just completely inappropriate for the goals, especially if they're an endowed organization, and just make sure that it's a prudent spending policy and then the allocation that's set aside on the investment policy statement aligns with that spending policy. We'll talk about this a little bit with the investment committee, but a good partner, a good OCIO or a good discretionary asset manager is going to be helpful in this space. They'll actually help look at various spending policies and what that looks like long-term through cash flow analyses and assumptions on what the markets will do going forward. So it's important to make sure you're working with a strong partner there. And then it's also understanding the short-term spend and contributions that the organization will receive. This is not always considered as much especially now, because cash is paying quite a bit, but cash can actually be a detriment to the organization if you're sitting on too much of it. So you want to have an effective cash policy. And that means really knowing how much you expect in contributions and how much you know you have to spend over the next 5 years or so that you're able to avoid a cash drag on the overall investment portfolio. Again, not an issue in today's market, but going back 5 years, that cash drag or if you don't have enough cash and the illiquidity piece or having to liquidate in a difficult market ends up causing a huge impact on portfolio performance long term. And we saw quite a bit of this in 2008. If you had to sell at the worst of the crisis, then it took 5 to 10 years to get back that lost return. So understanding that spending piece is very important for the board. The last thing I would say is making sure that the investment policy drills down into any particular types of investments the organization wants to actively be a part of or to avoid. So the big part of that is two things. It's public versus private. Is it appropriate, given the size of the organization, the size of the endowment or foundation, to hold private assets? And it's also the comfort level, how sophisticated the board or the investment committee is. And then also, is there any socially responsible investing that the organization would like to do just based on aligning with their own mission or goals and objectives? So I've seen this with environmental organizations where they would just do a screen against any public, because they only held public assets. So any public activities that went against their environmental goals. I've also seen this with Catholic organizations. There's general U.S. guidelines for investments that the organization will put in their investment policy that they want to follow the USCCB guidelines wherever possible. So I think those are the main things to think through as a new board member.
Such a balancing act, isn't it? Yeah. How much cash, how much alternative investments, all the categories that you're familiar with in investment policy statements. And then things change. 4 years ago, nobody wanted to keep any cash because interest rates were almost negative or zero. And now look where we are. So thinking about the new member of an investment committee, what's in your like investment committee 101, the basic level class, basic level training for maybe new board members that are onboarded to the investment committee or even to the board itself? A lot of those board members do have experience in finance and accounting or other business fields, but maybe not a lot of experience with investment management itself. And more importantly, supervision of investment managers. Talk a little bit about what you like to make sure that there's a baseline understanding among all the fiduciaries that are looking at the performance.
Yeah. So I'm going to come at this from a bit of a lens of discretionary asset management because that's my background. Yeah, there are definitely things to keep in mind if the investment committee is actually investing and evaluating each manager and hiring and firing 4 times a year. But I think we'll go into that a little bit when we talk about the outsourced CIO space. Yeah. From a discretionary perspective, I think performance management and peer comparison are probably the main things that people think of, and understanding, kind of making sure that the investment manager that you work with is actually showing benchmark performance, not just at the asset class level, but if necessary at the manager level for the entire portfolio. And then they're also showing peer comparison. Those 2 things are quite important to look at. And then it's also, how do you continually measure those investments on an ongoing basis? What's the right cadence to meet? How often do you want the investment manager to present to the committee? And then that ties into how much discretion should the committee have as they're managing this. So if the investment manager is within the bounds of the investment policy statement, then they should have full discretion to make allocation changes. So then where the committee steps in is if it's a new asset class or if it's a private investment that they need to approve. Getting the buy-in for the investment committee is really important for the asset manager, and making sure that there's that kind of trust and that relationship of being able to have that feedback from the investment manager to the investment committee. So I think that's a big piece of it. And then the other thing that they're going to look at besides just performance and when to approve new investments or when they need to have that oversight is also the allocation. So it's really important to make sure that the active management is there from trimming when you're too overweight to a specific asset class. And that ties into the resilience of the portfolio against drawdowns. It's not always thought about, especially in today's market. We're coming off of many, many months. The markets have been more volatile the last few weeks, but many months of good returns. So you don't always think about it, but there's probably asset classes, if they aren't being managed, that are overweight to what they should be. So trimming those and making sure you're within the allocation bands of an investment policy statement is important, because if you don't do that, then you go into a year like 2022 or like the financial crisis where you perform much worse than expected. And that really cuts into the spending policy that you have and the longevity of the endowment.
And can we give that like as maybe a specific example of an asset class, not particularly manager or a time period in history, but I have a vague idea of the asset classes that are usually described in an investment policy statement. But let's say an IPS had just 2 asset classes, what a couple of typical asset classes are. And do you have multiple managers in each asset class, or do you usually pick one asset manager for this class and a different manager for another class? And then you don't compare them one to the other. You compare them against their own peers. Do you have an example for us of an asset class and, to kind of give some concrete flavor to the analysis that you want your board members to understand?
Of course. So the most basic breakdown that you'll see on an investment policy statement are equities, which are public stocks, or bonds, which is fixed income, either held through a fund or holding an individual bond. And then there's typically a cash policy that's written up, which we discussed earlier, putting in place a decent cash policy. And then the fourth option that you might see are alternative investments. These can be public, but more frequently they're the private assets that you would hold in a portfolio, or they might be public assets like oil and gas or different commodities, gold, timber, things like that.
Okay, so you can get overweighted. I guess this is most easily illustrated as the interest rates have changed so much. The bond and fixed income 5 years ago was looking very different because you weren't getting significant interest related returns. And now, and then at some point in the past 5 years, that shifted pretty dramatically, and maybe you wanted more of that. How do you bring the investment committee along on how to rebalance and whether the managers that they've hired did what they were supposed to do in keeping track of that change?
Yeah. So this is actually great timing for that discussion. I just had this discussion with an investment committee. So from getting into an overweight that hasn't been managed, I think a great example of that is U.S. stocks right now, especially in the tech space. There's a lot of news out there about the Magnificent Seven and the performance in 2023. There's 7 stocks that drove a lot of the return for the S&P 500, the U.S. stock market. If you had exposure to that and you just let it grow, which maybe you'd want to do in your personal assets, but it doesn't adhere to the investment policy statement of a foundation, then you would end up being very overweight to that particular asset class, to equities, or if the investment policy statement breaks out just specifically U.S. equities. So it's a good idea to trim those when you have the gains, because then you're doing the age-old wonderful thing of selling something high when it's done very well. So that type of management around allocation is very important. And then within fixed income, then you would take that overweight and move it into the bonds that are now giving you a much more decent yield. Like you pointed out 5-10 years ago, fixed income, it's not that it wasn't important, but it was more just there for defensive purposes. It was certainly not giving you much interest. And now you can actually have some potential positive return if and when we get into a more normalized interest rate environment. Plus you get to lock in some significant excess income. So that's something that BNY Mellon has done is increased our exposure to bonds. And we are certainly seeing other endowments and foundations doing that where appropriate, where it's in line with their investment policy statement. So those are the types of discussions you would want to have with a discretionary asset manager. If I was sitting on an investment committee, I would want that, and I would want to be presented with those ideas and those tactical shifts to asset allocation that an active discretionary manager is doing on our behalf, because that's why we hired them. That's why we're paying them fees to make these tactical shifts. Because if you look back at performance metrics long term, those tactical shifts in asset allocation actually contribute more to performance from an attributions perspective than manager selection. So it's very important that a discretionary manager is bringing these good ideas and being an active partner in that space. This is why investment committees hire discretionary asset managers to make these tactical shifts that don't have to wait just for the quarterly investment committee meeting. And those tactical shifts in asset allocation over time, it doesn't have to be huge swings, but even, anywhere from 2 to 5% shifts away from one asset class into another. It's shown, if you go back and look at performance over time, that contributes more to positive performance just from an attribution perspective than manager selection. So that ties into the benefits of that discretionary management.
I do want to shift and really drill down into the OCIO and discretionary asset management decision making. But before we go to that, again, talking about rebalancing, I've seen situations where foundations have really significant allocations to private equity, and private equity tends to have limited opportunities to exit. And there are portions of it that require continuing contributions over time as new investments are identified and so forth. How does one think about the role of private equity, and setting aside the whole conversation about private equity not being as transparent and the protection that provides a foundation that wants a little bit more privacy in how its assets and resources are actually invested? But anyway, thinking, what do you tell the new committee member where there's already a private equity piece in place, or whether they should or shouldn't go that route? Is there a base level of understanding that you think people should be aware of?
Yeah. So the first piece is just making sure that the illiquidity would not interfere with the spending policy. And that's where you go back to revisit. And I think this is important for the investment committee to do. Revisit that cash flow analysis, that drill down into the spending policy. I do with some of my clients on an annual basis, just to check in. I mean, most likely nothing's changed. Their spending policy is fine. The allocation is fine. But check in and make sure that the private equity and the illiquidity that you'd have from that does not interfere with the spending policy. So you can kind of stress test and look at, if you have very poor market returns over the next 10 years, are you drawing down the public part of your portfolio significantly? Because then you would run into illiquidity issues within the private, because private investments typically last about 10 years, traditional private equity. So if you're locked up for 10 years and you're drawing down significantly the public piece, you have way too much in private equity, right? That's a good first way to check in on it. Private equity can have a great role in portfolios just to add some diversification away from public markets. There's a lot of return opportunity. Manager selection actually is quite important within the private equity space. So depending on the size of the organization, you might go like a fund of funds route where you have a lot of different underlying managers and private companies in one investment. Or if you're a very large organization, you tend to have a more bespoke portfolio with a lot of individual investments that do require active management, because you'll be getting distributions and calling capital into other managers over time. It's important to have a lot of active management around that space, because good managers tend to continue to deliver good returns.
So I think that is a good segue then to the outside chief investment officer and discretionary asset manager conversations. Can you talk a little bit about what the typical expectations are for an OCIO when a foundation wants to go that route, and how the investment committee can best select a firm for that position? What's typical in a request for proposals, and maybe some challenges that you see there from time to time?
Yeah. So on the investment side of things, I think this became a very popular space coming out of the financial crisis, and just understanding that from a fiduciary perspective, you really want to have more frequent oversight than a traditional investment committee. It's not that investment committees were doing poor jobs, but they're not doing this full time. They have other jobs. And so they're meeting quarterly, but that's not a very frequent hiring and firing of managers. That's not very frequent changes to allocation. So the financial markets just started moving more quickly, and having more oversight was better from a fiduciary perspective. So you've really seen the term outsourced CIO emerge with every major institution. Pretty much everyone does it now. Whether they call it that or just discretionary asset management, it's quite popular in the space. Most RFPs I see will ask for the full information on fees, on portfolio construction, on how allocation is decided, how investment management is decided. Do you have access to all third-party managers? Are they proprietary? Because then you get an understanding of if there's conflicts, or if there are fee issues where you're getting charged too much in fees because it's a proprietary investment. So a lot of that delves into any of the conflicts that might arise with discretionary asset management. And I think it's important you might end up having like a 50-page response to your RFP. So it's a lot more to go through when you're doing discretionary management hiring, but it's important to delve into all of those details. And so I think understanding the process that the investment manager goes through is probably the most important, because you want to really know from a fiduciary perspective why they're making those allocation changes, or why they're switching out investment management. And this is where I'll also see a lot of questions on socially responsible investing, and also when to use active versus passive management. And what I mean by that is, when do you want to hire and pay a little bit more for a manager that is going to try to beat a benchmark or be really active in a space like emerging markets is a good example. Maybe the manager is going to be super underweight China because there's not as much investment return in that space versus US markets where they're very, very efficient. It's very hard to, over multiple time periods, beat the S&P 500, kind of the Warren Buffett school of thinking. You might want to just do cheaper passive management in that space from an overall net of fees perspective. That I see laid out quite a bit in the request for proposals.
Interesting. A quick minute about benchmarking and allocation tracking and how the investment committee can approach. And I think we've touched on this a lot already, but maybe to wrap things up, intrinsic in all of the investment committee work is measuring the performance and assessing alignment. Do you have some summary advice, some parting thoughts for our listeners on how to think about measurement and assessing the alignment and how well the managers have done?
Yeah, I think this is a really important piece because I've seen sample performance reports and sample portfolio reviews that people would show that would not have any type of blended benchmark for the entire investment portfolio, or there would be a lot of particular selection for what benchmarks that they show. So there's two ways to think of it. There is an overall blended or portfolio policy benchmark for the entirety of the foundation, or a lot of times with foundations, you'll see it broken out between like a short-term pool or a long-term pool, or there's a socially responsible pool of assets. So could get broken out just depending on what the institution is. And you want to see an overall blended benchmark that's decided upon on the investment policy statement to measure performance. So a lot of times this is a blend between two different indices. So if the portfolio holds both public stocks and public bonds, you might have a mix between like a all country world index versus a aggregate bond index. So maybe like a 65-35 blend. So you want to be able to see that blend. And then also at the asset class level, you can see how the US stocks within the larger company space is doing against the S&P 500. So really drilling down into each asset class. And having both of those things is usually a pretty comprehensive way to review performance. And then the other aspect of that is also checking in on the allocation. So a lot of times with our clients, we'll show what the target weight for each asset class is. So if equities are meant to be 75% of the portfolio and fixed income is meant to be 15% of the portfolio, and then maybe there's some alternatives or cash in there, we'll actually show that target weight, the actual allocation of the portfolio, and then a minimum and maximum range. So how far underweight can we get? How far overweight can we get based on market performance? Because there will always be some under or overweight. You don't want to need to be rebalancing on a daily basis, but actually show those ranges to demonstrate that the portfolio is in line with the ranges. And we pull all of this directly from the investment policy statement.
That's a lot of work. And I would love to go into how socially responsible investing fits in with all this and mission related investing. But I think we need to save that for another episode because we've covered so much here. Any parting thoughts for our new investment committee member? Should they be calling their investment professional on their own? You know, is this all committee training? How does one come up to speed when you're really a newbie at the business?
Yeah, I think connecting with the other committee members and just getting an idea of how things have been done. And then if there's any suggestions that they have for how to improve going forward. And a lot of that is really just making sure that you have a really great, repeatable process for evaluating the investment manager that you're working with. That's the big part of it. And then always make sure you're refreshing how you view that investment manager. They're not going to be offended by going out for RFP or at least checking in on that. I think it's really common to do that at least every 10 years or so. Just making sure that the fees that you're paying and the portfolio that you're running are all still in line with the investment policy statement. You refresh what the investment policy statement is in regards to the goals of the organization. You are sure that the spending policy is up to date with the current market environment. So just those continual check-ins, not just, we get our presentation from our investment advisor, they're in line with the benchmarks, check, we're done. I think delving deeper, not every single meeting, but once every year, once every couple of years, just thinking about the best way to refresh that. And then every 10 years or so, even if you're happy, just going through that RFP process, it's a lot because you have to read a lot of RFPs, but you can do a very selective one, maybe just have like 3 to 5 firms that you request submit something. It doesn't have to be a big formal process, especially if it's a private organization. So I think that's a good best practice. It's not always done, but complacency tends to lead to underperformance and overpaying in fees. So it's always something that we recommend. Even when we're working with someone long term, you want to take a good look at it and just make sure that we're doing the best we can as well.
I think that's great advice and a great way to wrap this up. I often say in board training in general that board members, one of their primary duties is to ask questions. You just gave a great list of questions for the new committee member or even a committee member who's been on for a while. Ask these questions, and that will lead to better fiduciary management of this process and many others. So thank you so much for joining me and talking about all this. And maybe we'll find a time to dive into the SRIs, MRIs, and PRIs in another episode. Thank you so much.
Yeah, absolutely. Thank you for having me. This was really a fun discussion.
So that's all for this episode. For listeners who want more information about UPMIFA and investment duties, our EO radio show episodes 16 and 35 also cover investment topics. Be sure to check out the show notes for links to more resources, and for organized playlists on this and other related charitable topics, check out the Farella YouTube channel where all of our charity resources are collected. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.